Hello everybody and welcome back to the Daily Show where we talk about stocks, commodities and cryptos. There's little doubt that 2022 has brought some of the fiercest markets that we've seen in many years. And with the current sell-off going into 4 days, there's some stats that will interest you in today's video about what happened next. We've also got giant gaps that are left or inefficiencies in these markets, and that's something that may be filled as well. But the key here is not so much to look at just that picture, but to also look at the bigger picture. Are we heading to the 200 simple moving average? This zone has been hit many times in the past and is often added as one of the key levels of support in bearish markets. So with SP 500 turning into a technical bear market, yields inverting across the board, and a whole bunch of fear in these markets, what's in store next? Let's take a look at it all right now together. See you soon. It's an action-packed day for sure. Well, hello everybody and welcome back to the Daily Show here where we talk about stocks, commodities and cryptos. As per usual, we'll start off here by having a look at the last session and discussing some of the big moves, but it was red across the board. Everyone can see that here. And what happened during the session was pretty interesting. The market basically fell early in the session, then rallied through to lunch, not getting through to points that would break and actually create some kind of bullish movement. We'll talk about that more later when we look at our key levels moving forward on the charts for the stock market and other indices around the world. And then we sold off back into the low. So as we know, Wall Street likes to play in the start in terms of trapping retail traders, and they love looking at the close. And it was a sell-off of risk into the end of the day. The Nasdaq fell 4.6% and IWM, the Russell 2000, fell 4.7%, which is a pretty big deal. If we go through and we think about sector rotation, we have here consumer staples and financials, etc., holding up a little bit better. They were still down heavily, but these are more the defensive sectors, things like healthcare. The ones that were hit hardest, metals, due to, of course, concerns about economic growth around the world, clean energy, solar and gold. All of those areas were hit the hardest for the day, and again all sold off into the close as much as they could after that lunchtime rally. Let's now talk about what happens next though. So there's a lot of data and a lot of stats flying around, and as you would know by now, we're in what we call a technical bear market in the US stocks. So that is the SP 500, the major index, not the Nasdaq. The SP 500 entered the bear market for the first time. That is technically down over 20% with a close. So after this has happened in the past, usually the SP 500 actually has okay returns in the next 3 months. Now that doesn't mean that the market turns around right now. We'll talk about that later, but in the next 3 months, 80% of the time in the past, we saw an increase in price over that 3-month period from the date that it entered the bear market. Here's where things get interesting. 6 months later, the rot was there in the markets only 60% of the time. So almost just a coin flip was it above. And what this is telling us about markets is they tend to do something like this. Like that, with a secondary dip later. So while everyone's freaking out and fear is really reaching huge peaks, if we think about it objectively, this is still a very large case scenario that could happen in markets. And I think a lot of people are freaking out and not necessarily looking at it from that objective level. What about when markets are down this many days into the year? So 111 days, obviously a little bit more now. We were down 18.2%, now down 20% plus. The remaining 141 days in terms of the previous years this happened were actually positive. So another kind of semi-positive there in terms of the data and the stats. But let's look a little bit deeper under the hood and understand two big things. One, about the current data points and what we're seeing in terms of stats with these massive aggressive sell-off candles. And two, what's going on with bonds. Because as we know, bonds are smart and bonds are a very good precursor of US recessions. Now, in general, in the past, if we had over 50% of all yields inverting, that is the 2-year, 10-year, 3-year, 10-year, 2-year, 5-year, all of these different yield bonds, we tend to lead into a recession. Now, a lot of you will say, well, Tom, the recession's already here, man. What are you talking about? We're already in a recession. Yeah, there's absolutely a case to be said for that. And we're hitting now over 20% of all bond yields inverting. And the one thing that you can say about this is the 3-month yield can't invert. Because, of course, the Fed's been so slow to raise rates. What has that meant? Well, it's meant that the market is unable to invert when you've got a really low short rate and you've got a massive 10-year, 5-year, 2-year, etc. So there could be actually more of a statistic like 30% or even 40% plus that are starting to invert. This is a worrying sign for the US, no doubt, and it could also put a little bit of a stifle on any rallies that we do see, because of course that's the real bear case there. That since the 1970s has been 100% of the time when 50% have happened within the next 12 to 18 months, we have seen a monstrous recession in the US, and unfortunately they're just the stats that we've seen there. So where do things get a little bit better? Well, this is a stat that's interesting. S&P 500, 4 consecutive 1% daily declines. We've now done that. You'll notice in the past there's been periods where this has occurred. And it isn't many. In fact, it's not that many times at all since 1999 that this has occurred. Now, in everything but 2, which you'll notice here during the global financial crisis, we saw rallies off this point. That is, around this point, we saw rallies in the market because the market was basically just moving too quickly down and creating unfair prices, or just such a fast algorithmic sell-off that the capitulation or fear trade came in and markets rallied off that point. It didn't necessarily mean it was always the low, as we see, but it certainly is an interesting stat in terms of so much fear in this market. Speaking of fear, let's move over to the VIX. The VIX hit one of the key levels we look at, 35 on the VIX. So we blew to a new low, and at the same time, fear gapped all the way back up to 35. This is a key zone that's only happened a few times this year. We saw it happen, and we'll just quickly go out here to a daily. Let's just check this out so you can time this with the periods before. So we saw it happen back over here in December. Then we saw it happen in January, which obviously coincided with the low. We had a February low coinciding, of course, with that invasion. Then we had the March, the double dip. And then, of course, we had recently the 2nd and the 9th of May. And now we're back at this point. So maximum fear in some ways coming back in. When the VIX is 35, you've got to pay attention. It doesn't tend to like just ramping straight through that level. Sometimes it does, and even more fear is there, but 35 is a big zone for the VIX. So I'd like to know what you guys think down below. Was last night the shakeout on the stock market? Let us know in the comments down below. Do you think that the market's going up in the next 24 hours? Or do you think that it's just going to go down and down and down? We did a poll here on the channel as well, and I think 72% of you said that by the end of the week, we will remain bearish. An interesting poll there. Very, very big stats in terms of the general community thinking bearish. Let's move over to the US 2-year versus 10-year. This is the inversion that most people look at, and it's one the big banks use as well. 1% a new inversion created in the last 24 hours. Big deal here. Not good, not what you want to see coming out of the US economy. US 2-year versus 5-year getting dangerously close to inverting. That will just add to extra statistics of more bonds inverting. We'll continue to keep you updated to that, so make sure you subscribe. And as we know, while the US 2-year and 10-year are rising, which is just, they're at now 3.427%, that puts downward pressure on the markets. So when they started rising over here, back in the later half of 2021, we saw that really big pickup in the US 2-year. That coincided with sideways to down markets. And this is the S&P 500 overlaid with the 2-year. So if you think about the past, how could the market have gone up during a time of rising over here? That's because the companies were actually earning more money. So that means that the PE ratios were being substantiated. Now, right now, the market has got uncertainty on it. How much is all this inflation hurting demand and therefore hurting the earnings? So the forward earnings season is going to be another absolutely crazy period in these markets that people are going to have to pay attention to. Let's move over to the US dollar. The flight to safety is certainly happening. This is a mixture of different asset classes going down. People moving out of bonds, people moving out of treasuries, people moving out of obviously stocks, and of course crypto. And that's forced a new high here on the dollar index. For the stocks to turn around, we're really looking for the US dollar to also decline and show that that money flow is going back out of US dollars and possibly into risk on assets, which currently it hasn't done. Let's move over to gold. So gold broke through our 1830. And I want to just quickly show this because these are the same levels. If you go back through the videos for the last couple of weeks, we've discussed at great detail. We loved the 1830. We liked it here. It had a great turnaround. And this time it broke through. And now it's come back down to the previous heavy demand zone sitting around that 1810. So let's just jump into gold here and have a look at the formation on the smaller time frames. And we'll just quickly load this up. So what you'll notice is when it came back down to that 1830 again, the market just nosedived into it and didn't really show any formational change of trend. Over here it did. Look at the previous video we did on that formational change of trend. All of a sudden, we've actually got the first formation change of trend here on gold on the 5-minute. So while it still could pull back quite easily to something like an 1820, this is a promising sign here from gold traders showing that they want to pick up around that box zone. And at this stage, the structure is starting to turn around in the smaller time frames. Again, a positive sign there for gold. US oil, inflation, obviously the big thing here is yields. When US 10-year goes up, oil really likes it, and oil is still holding above that key demand zone around that 117.20. So if we get underneath 117.20, everything could start toppling for oil. Expect that to be coinciding with the yields going down, and at this stage, it still looks very strong with buyers meeting the demand here and trying to buy off that level. So we'll keep updating you on the oil and gas as we go along. Let's move into stocks. So Tesla got battered 647. Of course, shutdowns in China aren't really good for this stock either. And there is a heavy demand zone that we've marked up before at around that 600 to 626. This has been buying in the past. Will it be again? I mean, basically with something like Tesla, it's leaving big gaps kind of behind it. So each time it's dropped off, it doesn't seem to be able to fill some of these gaps. In some ways it did, but Tesla, coming under a lot of fire. And I think at the moment, it's better to look actually at the stock market indices such as the SP 500. And then if you like Tesla and you think the SP 500 or Nasdaq are turning around, that's a good point for you to say, okay, today is going to be, the Tesla day or the Apple day or anything like that. Speaking of Apple, Apple fell to a new low. It lost 3.83%, and that might seem bad until you look at some of the others. Amazon lost 5.5, Google lost 4, and Microsoft dropped 4.24. So Apple comparatively held pretty well. Is this a big support or demand zone? Not really. Apple just kind of leaves two big gaps behind it, similar to the SPY. It just fell. The algorithm sold so aggressively into this. And there is some form of previous buying pressure that happened around here. But look, Apple, your guess is as good as mine. If I was looking at that chart, still looks negative at this stage. And we look more to the other markets. XLY XLP shows that there's still consumer discretionary versus the staples. There's still a little bit of risk on here in the markets in comparison to the risk off kind of staples, but it's coming down slowly. And I can tell you that the bond market is undecided when you start to look at just the risk components. This actually hasn't made a new low. So that's interesting. The bonds, as far as the indicator that I use for them, that if you're interested in, you can always do the mentoring and find out more about it. That actually hasn't made a new low while the markets are. So that's kind of pointing to possibly this being a bit of a sweep area. That is the market creating max fear and then actually rallying back up. And it's not unprecedented to do these types of things. IWM, Russell 2000, big sell-off day, back into the huge demand that we saw previously. The Russell often is leading. At this point, it was playing catch up. And there's two massive gaps here. And this is the story of the markets right now. Massive gaps, extreme fear, huge sell-offs, and high VIX. Nasdaq is the same. Should it stop here? Well, it's filled the gap that was over here. A lot of people were mentioning this and they're saying, look, Tom, it's filled the gap. I see it's filled the gap that it left previously. Yes, that's actually fairly important. And that's something that's good in terms of the markets. And you can see as you bring that across, that gap and that fill that occurred finally for the Nasdaq, it eventually gets them. It just can be a long, long time away. Most gaps do end up filling. The statistics are something like 80% of gaps fill, but it can take a very long time to obviously fill those ones up. Let's move over to the S&P 500, the most important. We've discussed the idea of course, the decline long-term back down to that 3,500, 3,200. Maybe by the year end, we'll find out. But what about these gaps? Does or should it pick up? So the stats are 4 consecutive 1% down plus days. We tend to see a bounce. That's just the stats. We're looking at the stats here. We have gaps left. We have incredibly fierce markets and extreme fear. So while the market may look to you like, okay, just keep going down. And yes, technically this is a shorting market. Don't get me wrong. it's also left a lot on the table in terms of levels that it could come back to. And I think that heaps of people probably are trying to enter shorts here. I'm not too sure whether that's the best point to enter the shorts. If you're entering the shorts, you were seeing that Wyckoff we discussed, you were seeing this level and you're saying you want to short here, or trying to short any pullback that occurred. We obviously didn't get pullbacks because of the fierceness of the market, and it's back down to this level. This is really a zone where you see a lot of people exiting the markets from their shorts, and they often don't hold them through these levels. And just remember, the market loves coming down, dumping through areas such as it did over here, and then rallying up after it sweeps all of the stop losses and convinces everyone of shorts through these zones. These are demand areas moving forward for the US 500. Notice the wicks. We've got one where it just stopped. We've got another one sitting behind. So both of these areas could be zones to target in from the smaller timeframes. And speaking of smaller timeframes, why not jump onto the 1 minute? Let's take a look at it together and talk about what we did in the previous live stream. And of course, we do live stream every Monday open, so definitely subscribe if you're interested to that. And if you want to get more live streams, we do have a free 7-day free trial in the links description down below to our private community where I live stream the opens and talk about the SP 500, Nasdaq, gold, etc., and other markets like we do here. So 3820 was the zone that we decided was a pretty big level of supply. The market tried to come up and it tried to hit that level. Now, if you look at the Nasdaq, you'll notice the Nasdaq blew through its supply. That's why it's bad to look at during these times. S&P, maybe Dow. They're the key ones to look at when you're talking about scalping markets. It then sold that range, moved down. It actually had a decent little scalp that was through this area down here in this box. And then it rallied back up and it just couldn't quite get back to that 3820. So 3820 is a big deal here for markets in the next sessions. If it breaches through this, I could easily see it pull back and then rally through. I think a lot of people will be watching that kind of zone. It's not the be all and end all, but it's certainly the way it's interacted with this. You can see the orders, you can see the sellers coming in, getting more keen on selling than they were even here, and not quite letting the market up. So these points will be very, very interesting in the next 24 hours of trade. And remember, that's what it takes to be a scalper. You've got to be in there with those levels. Quadruple witching coming up very, very soon. We have some expirations on the 17th that show maximum pain. That's right. That is where if every order closed at the end of this week so far, where the stock market would make the most amount of money, that is the market makers or the composite man, that's actually sitting at 420. So that's way far off where we are right now. But with all of the news that you'll see soon, when we go over at the end of this video, with all the news you'll see soon, there's a chance that crazy things could happen. So I'm not saying 420, absolutely not. Do not rely on max pain. I'll say it again. TA number one, okay? TA number one, and then max pain, if it's coming with your technical analysis, cool. Otherwise, you can disregard it. Max pain is best used in coiling sideways markets. Speaking of other markets out there, Bitcoin and crypto has been incredibly painful for many. 32,000 was never breached. That allowed us to stay out of even thinking this thing was long. It's very lucky that we did that because, of course, we recognized the key supply zone over here and the trend change. The defended area, similar on the stock market, was broken. That just allowed full-on sell-off. And as the news comes out, little wonder why this thing's falling. Unfortunately, staking platforms around the world, some are locking up, some have literally just frozen money. We've seen other stories of big brokers out there, big kind of exchanges freezing cash and freezing transactions. So Bitcoin's in a wild market of its own. It's fallen to 21,200, and I think you'd be pretty keen to call any lows on this at this stage. We have absolutely no structure, and the one thing about crypto is it usually comes back to let you in. So that is, if it does rally, it tends to come back and create like a secondary kind of drop. So it might do something like this, rally up, drop, then pull through. And that allows you to get in. So I think, biting the bullet here on crypto could be dangerous unless you have a long-term plan. Be careful out there, guys. One thing that is positive is I guess it's getting back into that 20,000 area, which has been the previous high of 17. And of course, that big breakout zone from November of 2020. But if we look over at BTC shorts, they've spiked and they've dropped. They've done all sorts of things. Big shorts coming in from the big whales, but this is more of a ever evolving story. How many exchanges are feeling the pinch and how many staking platforms are in damage control, because that's going to be the story that keeps coming out. If you want to come, we're posting a lot here on Twitter this week and of course in our Discord community. So make sure you join the links in the description down below. Follow at FX Evolution on Twitter. And in terms of news, we have core retail sales coming up. It's probably going to be a bad number, you would guess. 8:30 a.m. New York time, we've got core retail sales. That's on Wednesday. Let's just go over here. Tuesday's PPI. And then we have the FOMC statement, funds rate, all of those things coming in on Wednesday as well at 2 p.m. and 2:30 p.m. for the press conference. So it is a week where you've got central banks around the world. You've got Fed Chair Powell coming out saying crazy random stuff. And we'll find out whether the market wants to rally this point or seriously get down to some of those levels that bigger traders have been targeting and conceptually thinking about for a little while. Stay safe out there, guys. Remember to practice risk management, and I hope you're having an okay day. It's a brutal market, there's no doubt, but remember to follow this channel, subscribe, smash the like button if you enjoy the videos, and we'll be there tomorrow talking about these markets with you. So stay safe. We'll see you next time. Bye for now.